Ladies and gentlemen, good day and welcome to the Q3 FY22 earnings conference call of PCBL Limited, hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sanjay Jain from ICICI Securities Limited. Thank you, and over to you, sir.
Thanks, Stewart. Good afternoon, everyone. Thank you for joining on a PCBL Limited Q3 9-month FY22 results conference call. Mr. Kaushik Roy, Managing Director, has fallen ill and is unable to join this call. We have Mr. Raj Gupta, CFO, Mr. B.L. Chandak, Executive Director, Mr. Pankaj Kedia, Vice President, Investor Relations, representing the PCBL on this call. I would like to invite Mr. B.L. Chandak to initiate the proceeding with his opening remarks, post which we will have a Q&A session. Over to you, sir.
Thanks, Sanjay. Good afternoon, ladies and gentlemen, and a very warm welcome. I will quickly take you through the update of last quarter, and then we open for question answers. PCBL reported strong operating performance during the last quarter. PCBL achieved highest ever sales volume of 1,16,594 metric tons during the quarter. This was backed up by domestic sales of 76,621 metric tons and highest ever international sales volume of 39,973 metric tons. If we look at the segment-wise details, tire accounted for 71,381 metric tons, performance chemical 35,378 tons, and specialty black 9,835 metric tons. 9,835 metric tons is highest ever sales volume in specialty black. Export sales jumped by 18% on Q-on-Q and reflected very strong international demand. With growing demand for specialty black and increasing global reach leading to new customer addition, PCBL reported highest ever specialty black volume in last quarter. PCBL achieved highest ever power generation at 150 million units during the quarter. EBITDA margin reduced slightly to 15%, primarily on account of higher sales in export market, where container freight cost was quite high, resulting in lower margins. The year-to-date 9-month FY22 sales stood at 3,228 crores against 1,793 crores in previous year, which is up by 80%. Profit after tax in 9 months was 337 crore against 185 crore in last financial year. Company remains optimistic about the global demand supply situation, and in view of best ever operating performance, Board of Directors declared an interim dividend of 500%. In the domestic market, we witnessed demand softness due to supply chain issues and semiconductor shortages impacting OEM production. However, this has created a pent-up demand, and we expect tire demand to show healthy growth going forward on the back of recovery in OEM sales across all segments and also in replacement demand. Demand for carbon black in the international market remains strong, where PCBL has been able to increase the volume in the market. However, higher logistic costs remain a challenge, which hopefully will improve during current quarter. With gradual improvement in supply chain conditions, semiconductor availability and vaccination drive, we are likely to witness good demand traction in domestic market. Also, consolidation in Chinese carbon black industry has opened up a large volume window of multi-year opportunity for us, and we need to grow rapidly and take advantage of the situation. Recently, you must have come across that name of our company has been changed from Philips Carbon Black Limited to PCBL. Limited. Since incorporation, name of company has been Philips Carbon Black Limited 60 years back. However, it is more commonly known as PCBL. Over the years, company has diversified its product portfolio and ventured into the production of performance chemical and specialty black apart from rubber black. And specialty black is used extensively in fiber, pressure pipes, wires, cables, food, contact plastic, engineering plastic, ink, paint, coatings, fertilizer, adhesive, and sealants. The company is also in generation of green power emanated from the process of carbon black manufacturing activities. Taking into consideration the diversified portfolio of the company and the fact that company is more popularly known as PCBL in the market, board and shareholders have approved the change of name from Philips Carbon Black Limited to PCBL Limited. Let me also give you update on expansion plans. Greenfield project of 1.5 lakh metric ton carbon black and 24 megawatt of CPP in Tamil Nadu is progressing well. Major equipment orders have been placed. Post completion of Mundra CPP in Q1 of this financial year, company expects commissioning of power plants at Palej 7 megawatt and Kochi 7 megawatt in Q4 this quarter in this financial year. We have also initiated work on the brownfield expansion of 40,000 metric ton of specialty lines at Mundra. Company has taken a lot of ESG initiatives and we have made sustainability as part of our key strategic pillars. And there are policies and governance structures in place. We are focused on improving our framework and a lot of work is going on. Our manufacturing plants have adopted zero liquid discharge process, leading to cleaner environment. We use the tail gases to generate electricity, and we remain committed to adopt best practices. We already have published second edition of our sustainability report, which you can go and see in the website. On Sustainalytics ESG risk rating, PCBL is ranked among top 13% in global chemical industry for FY21. This is the summation of some important developments of last quarter, and we will be happy to take your questions from here. And Raj Gupta and Pankaj also are joining me. Good afternoon.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vikram Ramalingan from Maybank. Please go ahead.
Yeah, thank you. My question is regarding these export sales. Since now they are becoming very crucial to the sales volume, I want to understand which geography and which country we are targeting, what are some specific initiatives we have taken, and will the plant the new plant coming up in Tamil Nadu, is it by any chance to exclusively serve certain export markets?
Well, Vikram, good afternoon. This is Raj.
Hi, Raj.
We have very strong presence in international markets. Currently, we are selling in more than 45 countries. Out of this, roughly about 80% is in Asia Pacific, and about 12% would be in Western European countries, and the balance is spread across different geographies, including North America, Latin America, Middle East, and Africa. Now, about 6 years back, when we were re-looking at our business, we also decided to de-risk our business from volume dependence on any single geography. and therefore we decided to invest in our supply chain network overseas. And in the process, we have established our own offices in number of countries, currently in 6 countries. And we have also tied up with our distribution partners in number of other countries. And the whole idea was that when we see one market not performing well, we can swiftly move from one market to another. And therefore, I mean, in last few years, you would say that whenever in domestic market we have seen demand softening, we have been able to swiftly ensure higher capacity utilization. Coming to Chennai plant, a portion of capacity will be sold in international market, but that is not exclusively for international market. We believe that initially about 30% would go to international market, and then of course, I mean, we will see how the capacities are getting consumed in India, and then accordingly we will allocate from various plants. I mean, for us, it is not material whether we are selling more, exporting more from Tamil Nadu or from Mundra or from Taluk. We look at the overall company level and based on the demand supply traction both in domestic market as well as in international market.
Thank you. My second question is this. Your freight cost, you said, has been very high this quarter, sorry. Is it mainly because of higher crude prices due to which the freight prices have gone up? And in this case, it usually becomes a double whammy for you, right? Because crude oil, CBFS is also a derivative of crude oil. So whenever there's a rise in crude oil price, your raw material as well as freight cost increases together, right? I mean, if I've understood it correctly.
Well, a part of freight cost certainly has gone up because of cost going up for the freighters, I mean the shipping agencies. But more than that, the availability of container ships is currently a major challenge. There has been a massive supply chain disruption in this segment, and the shipping rates have moved up significantly. Just to give you an indication, currently when we are selling in Latin America or North America, we are having to pay almost $10,000 for a container, which is 22 tons. I mean, which converts into $450 to $500 freight. In Southeast Asia, earlier our per ton freight used to be around $12-13. This year, and of course in last quarter, we had been paying about close to $100. So the freight rates have gone up significantly. When we sell in international market, we have to compete with the local manufacturers, right? And therefore, we have to sell on a landed price basis. Sorry.
Correct.
So if there is an increase in logistics cost, that actually impacts our margin, that eats into our margins. And therefore, the margins gets impacted this quarter, of course. I mean, that has been one of the reasons. But other reason I must admit is also the demand supply situation has also changed in last quarter. I'm talking only about the domestic market. OEM performance has been extremely weak. If you look at the current year's number, why last quarter, but whole of this current year auto performance, you will see almost close to double-digit dip in passenger vehicle production, around 15-16% drop in two-wheelers production, and about 35% drop in three-wheeler production. Only the MHCV sector is the one which has performed well this year, but then that's a very small portion, I mean, of the auto industry in terms of numbers. Now, this actually impacts tire demand in the industry, right, and therefore carbon black demand also. So, while with our long-term customers, which are mainly tire companies and where we sell about 70% of our portfolio, we have formula price arrangement and we get a pass-through when crude moves up or down. But in the balance 30%, that is extremely sensitive to the demand supply situation. And also with increase in our raw material prices, getting a pass-through for this increased cost is becoming a challenge in this kind of soft market. And that's the segment where actually our margins have gone down, but in the tire sector, the margins stand intact.
Yeah, fair enough. Thank you. That's it from my side for now.
Thank you. The next question is from the line of Chintan Cheda from Quest Investment Advisors. Please go ahead.
Yeah, hi. Good afternoon, sir. Thanks for taking my question. So my first question is related to so was there any inventory gain during the similar quarter last year?
There is no inventory gain as such in the last quarter. We had an inventory gain in the same period last year, right? And that was because of extreme level of crude volatility. So crude went down to 18 and then again it jumped back to that $55, $60. But that's actually a once in a very long while phenomena. It doesn't happen. So every quarter there is neither an inventory write down nor inventory gain.
So approximately how much was that?
At the same quarter last year, it was around 30-35 crores.
Okay, fine. And so my second question is, so this quarter we have seen a sharp decline in our gross margins. So basically our EBITDA per kg has gone down by around 10%. So is this attributed to this movement in crude prices, or maybe the export margins are relatively less than the domestic market?
So on the total portfolio, like I was trying to explain that this 30% segment, which is non-formula pricing segment for us, that's the place where our margins got impacted. If you notice, our raw material cost during the quarter has gone up by almost close to 10,000 rupees a ton. Right?
Okay.
And getting a pass-through for this cost in that non-formula pricing segment, that became challenging last quarter. We did not get any pass-through. And when I'm talking about pass-through, I am considering the increased rate also. Because when we sell in overseas market, the realization is high, right? Because internationally the price of carbon black is higher than the rate at which we are selling in domestic market. But then we are also having to incur freight costs. So net of freight, we could not recover the increased raw material cost in that 30% segment. And therefore the margins have gone down. However, we could see demand softness in domestic market. We could estimate it almost a quarter in advance, and therefore we also took some cost initiative. And therefore, while the drop at gross margin level is about 3,000 rupees a ton, but at EBITDA level we could restrict it to only 1,100 rupees. That is because of the cost rationalization initiatives that we took.
Okay. So suppose in a normalized situation, so where do we see our gross margins?
Our gross margins have remained very stable around that 29,000-30,000 rupees this year.
Okay, got that. And so secondly, what has been the volume for the performance chemicals during this quarter?
Around 31,000 tons. Sorry, 35,000 tons.
25. And for first 9 months?
35,000 tons.
25 or 35?
35,000 about.
Okay, got that. And just one more thing. So in fact, we have seen a very solid volume growth in our specialty chemical business. So do we expect to sustain this growth rate? And also, when do we expect to fully utilize our existing capacity of specialty chemicals?
Well, ramping up in specialty takes time because there's a lot of customer approvals that we need to obtain. We also need to broad base our portfolios. We can't keep on increasing volume of the grades that we have. We also have to launch new grades, right? And sometimes a lot of customization is also required. So it's a time-consuming process. We believe that from here on, there's a good potential for us to add around 10,000 tons of specialty volumes every passing year.
Okay. That was really helpful. Thank you.
Thank you.
Thank you. The next question is from the line of Uday from KSEMA Wealth Management. Please go ahead.
Hi. Hello, sir. Thank you for the opportunity. Sir, I just wanted to understand that what has been the raw material basket cost or let's say CBFS cost for you this quarter, because there has been a significant jump, and what has it been in the preceding quarter, and what do you expect it to be going forward?
So this quarter it was around 70,000 rupees a ton. I'm talking about the total raw material cost per ton of carbon black. And the previous quarter it was around 60,000. So during the quarter, 10,000 rupees increase.
And sir, any color on how you see this trend going forward?
There is further increase because we are all seeing spike in crude prices. Crude has already increased by almost $8 in last 7-8 sessions. So, but then this is beginning of the quarter, so it could continue to rise and it will have an impact on our cost also.
Okay, sir. So the final question, in terms of crude oil price, at beyond what price per barrel do you think it will take a huge hit on the margins? And what is the comfort level price range if crude oil is in, which is good for margins?
We can't look at it in isolation, right? Because we also have to look at industry demand-supply dynamics. So if we believe that Indian economy is going to grow at a decent rate, Indian exports are going to increase both in auto and tire sector, then overall domestic demand is going to increase. On the other hand, China carbon black industry is consolidating. They are selling less in global market, so that is also creating a larger opportunity for all other countries to export in other markets. So if those equations remain strong, there is no reason for carbon black manufacturers not to get pass-through of incremental cost. So in isolation, looking at crude at a certain level, I don't think that is a fair calculation or way of looking at the margins or realization.
Okay. And just so, how successful have you been able to pass through the costs so far, and will you be able to continue doing that going forward? That's my final question.
Last 5-6 years, we have seen crude at $18. We have seen crude at $88 also. And if you go through our last 5-6 years numbers, you will see that across periods, largely we have been able to get pass through. Now, see, no business can be completely immune to market conditions, right? Irrespective of the degree of management, I mean, crude management and all. So in situations where there is a major disruption in market, there is a strong demand correction, then some impact will always be reflected in the margin. But otherwise, largely, if you look at our last 5-6 years performance, you will see that we have been able to manage the situation well across different price points of crude.
Okay. Thank you, sir. All the best for the next one.
Thank you. Thank you.
Thank you. The next question is from the line of Rikin Gopani from Capri Global. Please go ahead.
Hi, sir. Thank you for taking the question. I have two questions. Firstly, just to understand how the our trends in terms of exports are expected to pan out. I understand this quarter you were able to sort of mitigate the weak domestic demand by having a higher export exposure. But overall, how is the trend, in the export market itself? And with the new capacity that is coming up, in case if this sort of moderate demand environment in domestic market continues, will you be sort of able to have a higher export share in terms of utilization there? If you could throw some light on the export trends.
Well, Rikin, so first of all, let me give you what we want to do with our segmental philosophy on the segmental philosophy. So so far as geographical allocation is concerned, as part of our vision, we want to create a proper balance between domestic market and overseas market. So in the next 4 to 5 years, once we have adequate capacity, our vision is to sell at least 50% of our volumes in international market. That's the direction of the company and vision of the company. Now, of course, I mean, current quarter, the jump that you have seen, that was more to manage capacity utilization because we saw a demand correction in domestic market. There was softness of demand here, right? Yeah. So have I been able to answer your question or is this something?
Actually, my question was more in terms of not the longer term vision that you have, but in terms of how the demand environment, because the scenario that you highlighted about the domestic market in terms of how the production and sales in the automobile segment has impacted the demand. The same shortage of semiconductors is also impacting the global automobile production levels. So in that context, I wanted to understand the overall market scenario in the export.
Okay, so structurally, the industry demand-supply dynamics are favorable to manufacturers. As I said, that there is a large level of consolidation in China, and therefore that's a large opportunity. That space is so large that despite all the capacity addition that is happening in India and outside in our industry, next 5 to 6 years, manufacturers are going to benefit on account of this space created, right? So structurally, it looks very promising. Now, interim issues are there. We know that there is a massive level of supply chain disruption which has happened. We know that semiconductor availability is an issue. But fortunately, gradually, all these issues are now getting resolved, right? So maybe a quarter more. But otherwise, we all believe that global economic condition is improving. It is going to be more conducive than what it was a year back. Domestic macros look very promising, right? And there are a lot of incentives being given to different industries by the government, central government. So I think overall demand should grow. If not at double digit, then very high single digit across vehicle segments. So overall things are looking very attractive, very interesting.
Understood, sir. Okay. And second question was with regards to the overall, situation in terms of pricing environment. So I just wanted to sort of hear your thoughts in terms of both the domestic as well as export market. What are the trends that you're seeing in terms of your ability to sort of price it with, broadly what we are trying to do is we are trying to have a steady state gross margin per ton, and then the improvement or deterioration is going to be driven more by the proportion of specialty black as a vision, right? So in that context, is it moving in that same direction? Are we seeing any particular change in trends towards the ability to have a steady state gross margin per kg in the core carbon black business?
Yeah, so I think that 70% of our business is to large customers where we have a pricing arrangement and which takes care of changing the cost structure, variable cost part, right? So the margins are largely protected there. In the spot market, of course, market is sensitive to demand supply situation. In some quarters, we make more margins. In some other quarters, when demand is less, then it also, impacts our margin. So I think it should not be, looked only in isolation for one quarter. If you look at a longer period of 1 year, you will see that, and especially when you compare, our current year performance with the previous year or the previous year with the year before, you will see that gradually there is an improvement in the margin profile. And that is because of three major things. One is that we have spread our geographical presence. So we are ensuring our capacity utilization across different situations. Second, we have taken a lot of cost initiatives and efficiency improvement initiatives, and therefore that is saving our manufacturing costs, and therefore the margins are improving. And third, the product profile also is changing. We are gradually moving up the value chain, not only in specialty but also in our rubber portfolio also and performance chemical portfolio also. We are doing a lot of customization. We are launching newer grades where the margins are high, where there is a entry barrier. These are not off-the-shelf products, right? And it also adds to the reputation of the company in being able to, provide newer solutions, superior solutions to our customers. So I think that's the direction we have taken. But it's a journey.
Yeah, understood, sir. That was very helpful. Thank you so much for answering the questions. I'm done.
Thank you.
Thank you. The next question is from the line of Dipesh Sancheti from Manya Finance. Please go ahead. Dipesh Sancheti, your line is in talk mode. Please proceed with your question. As there is no response from the current participant, we move to the next question. From the line of Abhijit Bora from Sharekhan. Please go ahead.
Yes, sir. I want one clarification. You mentioned that 70% of our sales volume goes to the customer where we have pricing arrangement, right? And 30% don't have the pricing arrangement, which saw the impact of the margins in this quarter. Is that the right understanding?
Yeah.
Okay. And secondly, from Q4 onwards, are we seeing normalization of demand in the domestic market? Because if that happens, then we can save on our international freight cost, which we saw in Q2 also. So is that a possibility that in next quarter we may see some margin improvement if that happens?
Well, we are seeing some improvement in terms of logistics costs coming down and also in terms of availability of semiconductors, right? But it will be, I think, a gradual process, and maybe it will cool down gradually from the current level. But as of now, situation for the quarter looks better than what it was in the last quarter. But again, times are extremely uncertain. We recently had the third wave of COVID. Fortunately, It was a mild variant. But again, these are times which are extremely uncertain. Every once in a while, something is happening. So, on a steady state basis, current quarter looks better.
Okay. And on a steady state basis, we can maintain a better margin of 15 to 16,000 rupees per ton, right?
I would not give any guidance on margins, but I would say that the initiative that we have taken, I just spoke about the 3 pillars, spreading geographical presence, improving our internal efficiencies and improving the product portfolio quality. We are working aggressively in that space, and surely it should reflect on margins. But I would talk more about directions rather than a quarter.
Okay. And can you give some guidance on the capex, like where we are in terms of our the capex we are spending on the expansion plan, and capex guidance for next 2 years breakup?
Well, Abhijit, so currently we are undertaking I'm not discussing maintenance capex, etc. and R&D capex, but we have undertaken 2 broad projects, major projects. One is in Tamil Nadu, which is around 150,000 ton capacity. It will also have a 24 megawatt power plant, and we expect commissioning of this project to be over by December 2022, which is just about 11-12 months from now. Another project that we are doing is in one of our existing plants, which is Mundra. We are planning 2 additional specialty lines there, each with a size of 20,000 tons. The lines are being designed now. Possibly it will come up in 2 phases. So first phase we expect to be over by March 23, and second phase we will communicate to you when we have some advancement with respect to designing of that line. But specialty, we already have adequate capacity to cater to our next 3 years sales volume. So as such, commissioning of these 2 new lines is not going to impact our volume for next 3 years. In any case, we have adequate capacity. So these are the 2 broad projects, and regarding the capital outlay, between this year and next year on these 2 projects, we expect to spend about 1,100 crores. Then of course we have maintenance capex and R&D capex and some brownfield capex, residual brownfield capex on PCB.
So you mean 1,100 crore for 1.5 lakh ton capacity at Tamil Nadu and 40,000 ton capacity for specialty carbon black, right? Both including 1,100 crore you will be spending over next 2 years.
That's right.
Okay, and for this 1.5, the capex is 400 crore, right?
No, this is 800 crore.
Oh, sorry, 800 crore, right?
Yeah.
Okay. And finally, if you can, we can this year we maybe easily do volume growth of around 16% kind of that range. So would we able to maintain such kind of growth rate over next say 2 to 3 years kind of time?
We believe the industry dynamics are supporting higher utilization of capacity. Of course, now we are constrained by capacity. Till the time Tamil Nadu comes, we would have very limited capacity to grow. But we believe that on a next 4 to 5 years horizon, we should grow at lower double digit at least. That's how we are seeing.
Lower double digit.
The volume growth. I'm not talking about the top line, because top
Yeah.
line will be depending on function of growth sales and now.
Okay. And if I can ask one more question, I just missed on the part that the specialty carbon black volume we can do additional 10,000 of volume on a quarterly basis.
No. I was talking about increase in our specialty volumes on an annual basis.
Okay.
So every starting year, we said that we are confident we can add roughly 10,000 tons.
On annual basis.
So if it is 35,000 utilization this year, then next year we expect 45,000 metric tons.
Okay. Thanks a lot, sir, for answering my questions.
Thank you.
And best of luck.
Thank you.
Thank you. The next question is from the line of Bharat Sheth from Quest Investment Advisors. Please go ahead.
Hi, Raj and Chandakji. Good afternoon.
Yeah, how are you, Bharat? Good afternoon.
Bye. Raj, just want to get sense that now will be commissioning around 19 megawatt power plant. So without any increasing, which is based on the waste heat recovery. So whatever heat which were generated so far was going waste and now will be converting, and this power will be available for third party sale, correct?
14 megawatts, 7 in Palej and 7 in Kochi.
So total
14 will be added in this current quarter.
14, correct.
Total will become 98.
So what is the connect? So I just want to get some kind of connect. So far this opportunity was not available, or it is now available with improvement
in our yield on power. So let us say, like we have taken initiative to improve our manufacturing process in carbon black. Similarly, we have also taken initiatives to improve power generation from the available energy in reactors, right? And because of that, we feel confident that we can generate more power. And because of this possibility, we are increasing the size of CPP so that we can generate more power and sell more power. So it's a low-hanging opportunity for the company.
Yeah, I understand. Now this 14 megawatt is for third party sale, and what kind of PBT level it can contribute?
See, again, it will depend on lot of things. What is the kind of tariffs which are prevailing in the market? What is the product
expecting that current level, Raj? If you expect that.
Bharatji, like if you look at power performance this quarter, you will see that we have generated the highest ever power in our history. And that was because we added Mundra in June. So Mundra new CPP is becoming streamlined, and because of that, there is a significant improvement in power generation. Like in 2020, I'm not considering 2021, but 2020, which was a full year operation for us, we generated just about 200, we sold just about 280 million units of power. And this year in 3 quarters already we have sold 231. Right? So on a full year basis, if I were to annualize, then we will be doing about close to 320 million units, which is almost 17-18% higher power sale. Right? So this will keep on increasing. Typically, Amit, to answer your question in absolute number, but it will depend on a lot of things. 1 megawatt power sale at current tariff fetches is roughly around 2 crore 40 lakh rupees.
Okay.
1 megawatt.
Okay. Thank you. That's all, and all the best.
Thank you, Balaji.
Thank you. The next question is from the line of Sanjay Jain from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity. Couple of questions. First on the specialty side, last 2-3 quarters has been quite a stronger quarter versus how have we delivered the growth in the previous few quarters. Now, what is driving the growth in the specialty? What is the application? What is the geography which is driving a strong growth in specialty? That's number one. Number two, we are adding 2 more lines on the specialty side. What is the product category or the segment within the specialty are we targeting in these new two lines? That's my first question.
Okay, Sanjay. So the first part of the question was about why this high volume growth. Well, so I was talking about our investment into our distribution and supply chain capability, right? And that is done for both rubber as well as for specialty. So we have a now wider spread across geographies and a better customer connect. So today we are selling to who's who in the specialty customer segment globally. All the big names we are there in some grade or another. Now, so one part is that we have broad-based our customer connect, our customer base, that's one. Second is we are also increasing our product portfolio in this segment. Last 5-6 years, every year we have been launching about 7 to 8 newer grades. And for that, we have also invested heavily into R&D capability. You know that currently we have 2 R&D centers, one in India, one in Belgium, and there are about close to 50 odd professionals who man these facilities, right? And the Belgium addition is a new one, happened about 2 years back, and we are adding numbers there. These are all seasoned R&D professionals, and we believe that our pace of launches will increase further from current level. So a lot of projects that they have taken up, both on the grades which are available in the market but not with us, and also some of the grades which are futuristic, which will cater to newer requirements in different application segments. So we are also expanding our portfolio, right? And third, this market is very large and we are the new entrant, right? It's a 1 million ton market growing at about 7-8% annually, and we are still doing just about 4% of this market. Considering our reputation in international market in this space, there's a long way for us to go. So next 4-5 years, we don't feel there would be any obstacle in our growth, considering that run rate which I talked about currently. Now, the new lines that we are adding, again, it is with the same perspective, because specialty we can't produce all the grades on the same reactor type. We require different kind of reactors to produce different grades. So the process is that we develop newer grades at the lab level. Then for us to produce those grades, and we get it tested with our customers, right? And once they are approved, then we also have to produce it at industrial level, and for which we need to design our reactors. And once the reactors are ready, then we produce it in this reactor, and again we have to sample this with our customers, and then again it goes through the approval process. So it's a long, gestation process. Currently, the 4 reactors that we have in specialty cannot cater to the grade that we have developed at the lab level, and therefore we are trying to design 2 new reactors. And this is continuing. These reactors, typically in specialty, the reactor size is very small, and producing just about 15 to 20,000 tons a year, right? Because these are only designed for number of grades which we can produce. Have I been able to answer your question, Sanjesh?
Yeah. Just one bit there. What is the application? Can you give some breakup on the application for the specialty today? How much is coating in non-tire rubber in that?
Well, so I'll give you a percentage. So in terms of our bandwidth to produce different grades across different specialty segments, currently we have the ability to address almost 90% of plastic market, polymers market.
Okay.
Last 4-5 years, we have been researching more on colorant grades, which goes into fibers, ink, paint, dyes, coatings, right? And we started with almost 0, and currently we are addressing about close to 40-45% of the requirement in this segment. And the R&D team currently is focusing more on the superconductive grade, which will be catering to the new age batteries, which can store more power. So the immediate next 2 lines will be addressing more of the ink, paint, dyes, colorants, coating segment.
Okay. The 2 new will be focused on ink, dyes, and coloring.
Yeah.
Got it. Another a slightly bookkeeping question. We spoke about a very sharp jump in the freight cost and a much higher export volume. But if I look at the other expenses, it has actually come off significantly on a quarter-on-quarter basis. Do we recognize the price cost above gross profit?
Would you please repeat your question, please?
Just on the price cost, we said that we have done a lot more export, and this time around the freight cost was higher. But if I look at your other expenses, okay, other expenses is in fact has come down sharply. So where does this higher freight cost in our P&L line item is reflecting?
No. So what happens, especially in case of export, we sell on a landed basis.
Okay.
Right? We sell on a landed basis, but our contracts are FOB.
Mm-hmm.
Right? So suppose if the landed price is $1,600, say, for example, and the freight cost is $400, because the freight is being paid by our customers, they will give us only $1,200. So in our realization, only $1,200 will reflect.
Oh, we don't recognize it even in the top line and nowhere. So it doesn't come anywhere in our P&L. It is X of the freight cost what get recognized in the
On
P&L.
the export side, yes. On the export side, this is how, because most of our contracts are FOB.
But we are basically instead of 1,600 per ton metric ton of revenue, we just recognize 1,200 because 1,400 freight cost is actually completely skipped from the entire P&L line item here.
No, our invoicing itself is $1,200.
Okay,
our invoicing itself will be $1,200 because we are not paying the freight.
Okay, from the cash flow perspective, you are not paying the freight, so you don't need to recognize that as a 1,600. Now I got it. That's why I was wondering why the freight cost was not showing exactly what you were telling. Now coming on the sustainability of the gross profit. Now, last time when we spoke on the call, Mr. Kaushik Roy was quite confident on 30 rupees and he was speaking of possibility of improvement as we are adding more power capacity, the specialty is rising. With the crude being where it is today, do you think there could be a near-term risk to that assumption?
Sanjit, I would not give you a guidance on one quarter because one quarter is too small a period for us to even estimate what is going to happen and take corrective action. It takes a little time to modify your strategy based on the changing dynamics in the industry. Right? So I will not talk about one quarter, but we are very confident that directionally crude at whatever level in isolation cannot have any impact on our performance. We believe that the opportunities in the industry remain very promising. I was talking about China vacating a lot of space, and that is reality. Last 2 years, they have been utilizing their capacities about close to 40% less, and there are reasons for that. I mean, we discussed that in past. The cost structure has changed, so that remains a large opportunity globally. And in domestic market, I am sure you all feel that India has a lot of potential to grow at a higher rate at economy level, and we are equally optimistic about the growth in auto industry, right? Because with increased income level, we believe that per capita vehicle consumption should go up. It is very low. So from that perspective, if demand supply dynamics are favorable, there is no reason why at any crude price our margin should be impacted. Because at the end of the day, as long as our customers are able to pass on the price to their customers, and the end customers, which is auto, if they can pass on the price to customers, their customers, which is retail customers, I think it is okay. I mean, the pricing gets built into, the cost gets built into the pricing.
Fair enough. One bit last from my side. To understand the path towards reaching that 50% contribution from the export side, what's our thought process and what is the timeline that we are looking at for us to achieve this? And this also means that we need to put a lot more capacity as we go forward. So what's the thought process on that side?
Sanjay, you'll have to repeat your question.
So you said that you are aiming for a 50% volume coming from the international side, right?
Yeah.
Not now, obviously, over a period of time.
Yeah. Yeah.
That would demand a significant expansion in the capacity, assuming that domestic demand keeps growing at 70%, and we are at a 35% kind of a contribution on the export. That means this Chennai capacity will not be sufficient to reach that. So are we planning more capacity expansion, more land buying? What are we planning post Chennai to reach this kind of export volumes?
You're right, Sanjay. We believe that the capacity that we are adding is not going to be adequate, and every 2 years possibly we'll have to have a similar kind of capacity addition. Right? That's how we are seeing at least next 5-6 years. And Chennai, we have surplus land, so there is a scope for us to grow further. And in fact, we are planning additional capacity in phase 2 in Chennai. Also in Mundra, we still have space, so we can add more capacity there. But if we have to put up a large plant somewhere, then we'll have to acquire land. We have not got into that process yet. It will also require, negotiation with the state government for what kind of benefits they can offer. So it will depend on that. But the process is going to start very soon. We believe that by the time this plant comes, we'll have to gear ourselves up for some large capacity immediately.
Fair enough, Raj. Just one question. I'm sorry for jumping on. The coal prices looks like again started moving up. I know crude is also moving up. Do you think this rising coal prices again give you an opportunity to grab market share? How do you see this volatility in the coal price in the view that this time crude is also increasing? So you feel that that advantage what you enjoyed say for last 2-3 quarters will go off or will have no incremental benefit from this time around rising the coal prices?
Well, yes, immediate fallout of this is yes, carbon black oil is again going to become more expensive. But having said so, higher energy prices are not favorable for any industry. And our own sense is that possibly at some level it will be a big incentive for the miners to produce more, right? And eventually price will again come down, both for crude and coal. So maybe currently what we are seeing is because of maybe some cartelization, maybe some shutdown of operation somewhere, but this cannot persist. Especially crude prices at current level, it gives huge incentive for the oil producer to produce more, right? And therefore, with the increased supply, prices should again soften from the current level. So maybe 1 or 2 quarters it can happen. We have seen in past also, but conventional energy pricing remaining so high for a prolonged period doesn't look likely. That is what our estimate is.
Fair enough. Thanks, Raj, for taking all my question and
thank you
for your comment on this.
Thank you. The next question is from the line of Akash Vora from Praj Financial. Please go ahead.
Yeah, sir, just wanted to know if we give out the spread data of feedstock and carbon black.
The spread, currently the gap is around $300.
$300?
Yeah. You can look at our presentation in the website. You will have some details.
Okay. And has it been maintained or increased in this quarter as well, sir?
The gap is increasing on our favor because the prices of carbon black oil is also going up.
Okay. So that's favorable for us, right, sir?
Yeah. Yes.
Okay. And sir, we've done QIP around in October for 400 crores, and recently we announced a heavy dividend. So just didn't understand the context between the two. One side we are announcing a QIP, and another side we are distributing a heavy dividend. So any idea you can give on the same?
Yeah, all along, I mean, even when we were doing the calls with investors during this QIP process, we were asked this question whether what will we do with our dividend payout, and we always maintain that company believes in distributing current profits to shareholders. And it is not very heavy. If you look at our last year's payout, we did about 39% of our earnings in payout. And this year also, I mean, based on our estimate for current year's profit, it is just around the same numbers. So we have not increased the payout ratio. In absolute term, it might look higher, but our earnings have increased in this period.
Okay, got it. That helps.
Financial year, you see, we had 312 crores bottom line, and in first 9 months we have got 337 crores. So that also speaks.
True. Got it. That helps, sir. Thanks.
Thank you.
Thank you. The next question is from the line of Promil Jain from Electron Portfolio Managers. Please go ahead.
Yeah. Hello, sir. Thanks for the opportunity. Sir, I just want to understand, our specialty black volumes have been pretty robust, and so here, what would be the split between, let's say, domestic and exports for this quarter? And also, if we usually say that the spreads are higher in specialty black, so was it not supported in the gross margins this time?
Well, Promil, we do about 70% of our volume in international market now, right? Because Indian market overall demand remains very small as compared to the overall global opportunity. So the incremental sales mostly would come from overseas markets. In terms of just one moment, please. Now, in terms of margin profile over a long period, last 5-6 years, has remained stable, right? And currently we are doing about 2.5 times of our rest of the portfolio margin in this segment. So there is no issue with respect to margins in this segment. It's a very niche segment. The entry barrier is very high. There's a lot of customization. It's a very time-consuming process to get approvals from the customer. So the margins remain, and that's the incentive actually to invest in R&D and PVC.
Okay. And as the phase 1 of the specialty black also comes through, should we expect that, on a normalized basis, of course, not maybe the next quarter or something, but on a more normalized basis, the overall EBITDA per ton or per kg should marginally keep on expanding along with the cost efficiency plans that you have?
Yeah, that's what has been happening. If you look at our last 5-6 years numbers, you will see that it has happened every year. Directionally, it will continue to happen.
Okay. And lastly, any capacity creation on the carbon black side and the specialty black side globally?
Yeah, some capacity.
Anything major?
See, there is some capacity which is getting added in different parts of Asia. Primarily because China is consolidating and a lot of countries were largely dependent on Chinese import. So Indonesia is adding some capacity, Malaysia is adding. There is some capacity which is getting added in Russia. India is adding capacity. So capacity will come up.
Okay. Got it, sir. Thanks.
Thank you.
Thank you. The next question is from the line of Sachin Kasera from Swan Investment. Please go ahead. Mr. Kasera, your line is in talk mode. Please go ahead with your question, please.
Hello. Yeah. Hi, this is Shravan here. Sir, my question is on the other expenses side. We could not understand, you explained to the earlier participant. So what should we consider in terms of our other expense run rate going forward? There's a sharp drop in the other expense. So just your thoughts on that. And what led to this reduction?
No, so this quarter we were sensing demand softness in domestic market, and therefore we deferred some of the costs. So I would admit that this reduction is not very permanent in nature. Maybe out of the saving of about 16 crores, about 4-5 crores is what which we can call a permanent saving, but rest is all deferment. So we deferred some of our maintenance activities to next quarter. Primarily, it is because of that.
Right? So you're saying 4-5 crores will retain is what you're saying?
Yeah, I mean, that we have been able to retain, but balance will hit us in next quarter or quarter after. But we should not look at any, item in isolation. I mean, when we are talking about the performance, financial performance of the company, we are considering everything. Revenue, our raw material costs, our other expenses, everything.
Correct. So because it was 127 the previous quarter, and now even if you're retaining 5 crore to this, we're still at 112 crores. So so what I'm trying to come at is our gross profit per ton has gone down around 3 rupees quarter on quarter. So the other thing remaining same, should we our EBITDA per kg should be back to around 17-18 range in next 2-3 quarters?
It doesn't add up to that. See, 5 crore saving on a 4.5 lakh volumes every year, it is just about 100 rupees per ton on EBITDA. So it doesn't add up to that 2,000 rupees. And that is not the way it should be looked at. I think we have given you broader guidance in terms of where we are heading, right? And God willing, we will be there. We have taken cost initiatives. We have taken efficiency measures, efficiency improvement measures, and we are also expanding our portfolio. Right?
So because historically we have had a run rate of around 17 rupees a kg in EBITDA. So
I mean, in 1 quarter or 2 quarters it might have happened, but on a full year basis, I mean, if you look at our last 5-6 years, 2014-15, our EBITDA per ton was only 7,000 rupees. And if you calculate the number of years every year, you will see that every year we have been able to add 1,000 rupees. More than 1,000 rupees actually.
Okay. And now coming on the specialty black side, we've guided for around 45,000 tons. Is my number correct?
Sorry?
The specialty black volume by FY23, what is the guidance are we sharing?
I spoke about it. I said about 10,000 tons we feel confident of adding to our current year's volume.
Okay. Is it more on conservative side?
No, this is something what we do. It is very conservative for a basis.
Okay. And sir, what is our current debt?
Our current debt is on net basis, we are currently 0 debt, but gross debt was around 550-60 odd crores.
Okay. And over next 2-year period, what should the debt be on our books by FY24 end?
It should remain similar level. Directionally, we want to become a debt-free company. So it will again depend on our growth plans and all. But based on our current projections, we believe that in next 4 to 5 years, we should become a debt-free company.
Okay, fine. Thank you.
Thank you. Ladies and gentlemen, due to time constraint, we take one last question from the line of Ashish Kacholia from Lucky Investment Managers. Please go ahead.
Yeah, good afternoon to the team, and congratulations on a great performance in adverse circumstances. So my thought is one of the other participants also raised this point about us kind of giving out a huge dividend and having done an equity issuance also in the recent past. So what's the thought process going forward? I mean, why don't we just reduce the payout because we have such big expansion plans, conserve some cash and use that for investing rather than paying it out to shareholders who then have to pay a 40% or a 42% tax on that? Isn't it far more just efficient to keep the money with you guys and kind of use it for expansion rather than issuing fresh equity? And every time we issue fresh equity, the market kind of puts a cap on our valuation as well. So we trade at a 10 PE. Given the financials of our company, we should be trading at a 20 PE. So what is your thought going forward in terms of this capital allocation and dividend? This like one pocket, another pocket. Thank you.
Your suggestion on dividend, we will take it to the board level. So we will inform them that these are the thought process of yours and let them look into this. Well, these are the board decisions.
Thank you, sir. Thank you very much.
Thank you.
Thank you. That was the last question. Ladies and gentlemen, on behalf of ICICI Securities Limited, that concludes this conference call. Thank you all for joining us, and you may now disconnect your lines.